Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, May 23rd, and then we'll see how things look for Wednesday, May 24th. We had a pretty significant down day. On the positive side, we've worked off these overbought conditions that we've been dealing with, or extreme positive readings, and we haven't really switched over negative yet, but we are showing some weakness. What we're going to be looking for now is where do we go from here? We went up to hit that resistance. We've come back down. The NASDAQ and NASDAQ 100 are starting to pull back. Is that going to shift over to a more negative stance, or are we just wearing off some of this exhaustion before we get set to go back higher? That's what we'll be watching on Wednesday. Before I get started, there are a few things to go through. I have a supplemental video that I recorded just over 2 weeks ago. It has to do with the S&P and its relationship to interest rates. I showed some of those charts in yesterday's video. It's a little outdated, but some of the charts haven't really changed all that much. The whole premise is still the same. That's why we keep a real close eye on interest rates. I do have a PDF of all the slides and charts that you can download. And please let me know if you're using that. Because of my next point, I can't do the zooming. If you watched Tuesday's video, any chart that was really telling us anything, I tried to zoom in on that. Unfortunately, it's very energy hungry in the program that I use to create the videos. Now, when I can get a computer with 32 processors and about 16 terabytes of RAM, fine. But it makes my machine very unstable. It takes me 2 to 3 extra hours just to do all that zooming. I just want to spend time doing other things and developing other parts of the program and classes that I want to make available to you. So please download the PDF and see if that handles a problem. I understand why you want me to zoom in on charts. They're a little bit hard to see, and when I zoom in, you can see things a lot better. That is why I upload the PDF. See if that is an answer to your situation. If not, let me know, and I'll try to come up with another alternative, which I really don't have right now. The only thing is to take longer doing the videos and do the zooming. But let me know, is it that big of a deal anyway? Some of you have been watching these videos for quite a while now. Let me know what you think, if you're getting any more insight or not by using the zooming, or is it just the same anyway? I do have a private Facebook group, and welcome to all new members who've joined over the past few days. I did post some things in there that I'm not posting on the YouTube channel or on Twitter. This is meant to be more private type of postings, and I probably will end up posting a lot more that I wouldn't necessarily share otherwise. On Monday, there was this story that came out, and I was busy editing yesterday's video. I wasn't able to really look through a lot of the stories. There was a fake photo that was produced using AI showing an explosion at the Pentagon. And right after we opened on Monday, you saw where the market really tanked. That's what I posted about in Facebook. These kind of things can hit the market a lot. For example, when Kennedy was shot back in 1963, he was shot at 1:30 p.m. on November 22nd. When the news started to go on television and radio, the S&P ended up dropping 2.8%, and within 40 minutes, they ended up closing the exchange. This is before we had Twitter, Facebook, Telegram, Instagram, all the other social media platforms. So when something like this happens, things can really go down quickly. But when it was discovered that this was a fake, the market quickly went right back up. Now, we ended up falling later on anyway, but that was more for other reasons. For example, on 9/11, I was really watching the market that day. This is before the market even opened. The futures had been positive, and it was looking like we were going to have a pretty positive day. Well, then the plane hit, and within about 10 seconds, the futures went from positive to being down massively negative. That told me something was wrong. Then after that was when all the news started to break out. The reason why I bring that up is I know a lot of you use stop loss orders in the market. This can really wreak havoc on that. I don't really have an alternative, especially if you're not able to watch the market all the time, because there's flash crashes that can occur. There's events that are rumors or truth that can hit the market, and the market will instantly react to that. But just be aware that those things can happen, and they do happen. I do have a poll that's posted this week, and I do also post videos on Rumble, That's mainly as a backup, even though I have a number of viewers that is all they use. But if you can't find me on YouTube, please switch over to this channel on Rumble and see if you can find the video that way. Also, there was an interesting article put out by Chris Shavako. He's the video that I like to watch every week, and I recommend that you do that too. He also posted on a site called Seeking Alpha, and it talks about comparing what we're going through right now, the debt ceiling crisis, how we looked back in 2011, how we've looked at other times in the past before we got set for a big fall, and then to compare that to what is actually happening right now. So you might find that useful, but I try to go through those things in the videos. All right. Enough of that. Let's go back and talk about what happened. We had a gap lower open, and prices tried to find support down at R1 at 41.78. As the day went on, prices then kept falling. They didn't hold at that support level. We broke lower, and we tried to find support at S2, 41.64. That didn't hold, so prices broke below S2, but didn't get all the way down to S3, so I don't have that on the chart. That was at 41.35, and we ended up closing at the low. So it was a negative day overall. Now we have to see, where do we go from here? We were down 1.12%, and this is interesting, on above average volume. You have a lot of folks that really don't trust what's happening in the market right now as it's been going up, and they're pretty trigger happy. If they see things going against them, they're going to get out pretty quickly. The technicals were still positive, even in the short term, but we're showing some weakness. If we see follow-through downward action, that's going to shift things in the short term anyway to looking more negative. Intermediate term also showing a little bit of weakness, but longer term, we're still positive overall. A lot of that right now has to do with the debt ceiling issue. That's what's driving the market, even though inflation and interest rates are always in the background, and then any more banking information that we may get. What are some comments that we can make? There's a lot of uncertainty about the debt ceiling. No deal is imminent, and both sides are not even close right now. That's the latest news that seems to be coming out, but that can change at any time. There's also a new COVID wave that's sweeping through China. Some of you know that in addition to this, I also teach English to Chinese children online, and I have a couple of students whose parents have contracted COVID right now. The 4,100 level is still providing significant support. That's if we continue to fall. We're still having a lot of trouble getting above 4,200 as overhead resistance. The dollar was up and interest rates were down. We have the 10 to the 5, the 10 to the 2, and the 10 to the 3 month, which all remain inverted with their yield curves. Sentiment is still positive, though. It ticked down with the down day. It had been at 69. It closed at 66. Our trend is still positive. The ADX is trying to move back up above its moving average, but the green line is coming down even though it's on top. Both the ADX and the moving average are below 20. Our bias is now negative with the down day, and I've switched our momentum back to mixed. Economic reports that came out, not a real big market mover. The IHS Market Manufacturing, the preliminary reading came in at 48.5. Last time it came in at 50.2. And then the services PMI came out at 55.1. That was greater than the 53.6 that we received last time. New home sales came in up 4.1% on a month-over-month basis. When you adjust this to an annual basis, that's 638,000 units, more than the 660,000 that they had expected. Last time there were 656,000. On a year-over-year basis, it's up 11.8%. Isabel Net charts. Here we have, whenever the Fed has previously hiked in the past, a recession has followed within months. What we're noticing over on the right-hand side is just how quickly the Fed has been raising rates. And that can't help but do some damage to the economy, at least slow things down. Then on the next chart, the 10 mega-cap tech stocks against the S&P 500 and the S&P 490. That's when you take out those big stocks. And it's been re-indexed back to 2014. It just shows how these big companies have really been outperforming. And they asked the question, did the launch of ChatGPT save the world? It's really an exciting thing to research. Other people are out there saying this could be the end of the world. We'll have to see how that plays out too. Then the top U.S. companies by market cap relative to the total just shows how most of the bigger companies have most of the weight. Then GDP from Goldman Sachs, they're still suggesting for the first quarter that we're positive. They also think that we're actually going to go up a little bit in the second quarter and that we're not going to hit a recession, according to them. Now, these black diamonds are the consensus. They're seeing things a little bit differently. This is earnings sentiment, meaning how are people feeling about earnings? And overall, worldwide, they're tending to see that earnings are going to improve into the future. Then we have a 25, 25, 25, 25 type of portfolio that some folks have. That's 25% in large company stocks, 25% in small stocks, 25% international, and 25% in short-term treasuries. And if you do that, so far, you're up 20%. Now, getting into our charts, where we did have a gap lower, right at the open, we came down to S1, tried to set up some support here. We were just chopping sideways. Then we fell down below S1, came down to S2, tried to set up some support here. That wasn't working, so then we fell down through S2. Again, as I said, we did not come all the way down to S3, but we did close near the low for the day. Intraday, where the futures had been quite positive, but then we saw some weakness before the market opened and they actually went negative. Then we have the session where things really fell and we're chopping a little bit higher in the initial overnight session. Growth continues to outperform value, but both were weak, and growth was actually down a little bit more than value with the large caps, also down more with the mid caps, and also down more with the small caps. Then looking at our growth to value ratio, we are showing some weakness overall, but near the latter part of the day, this is kind of interesting how we were coming back up. This could suggest that some of the smart money is going in and buying growth on weakness. Looking at sentiment, fear is still very, very light right now, meaning there's a lot of complacency. With the down day, the VIX did go up on the line chart as well as on the bar chart, and we also saw a pickup in volatility of the VIX as well. This fear gauge is still continuing to go down, which is kind of strange since it was a down day. This other fear gauge is pretty much going down overall to sideways. And then we are seeing a shift here from going from a risk off type of posture. That's when this ratio is going down. This line keeps improving, suggesting that we might be going back to a risk on type of posture. Our advanced decline line, we were down based on price and volume. We're still seeing a shorter term negative divergence because volume is below its moving average. Longer term, we're also seeing a negative divergence. The new highs, new lows still continue to go up with the 5 period. They're pretty much flat with the 10 period. We didn't see a real significant number of new highs because of the down day. We're a little bit below zero now on our advanced decline ratio. Accumulation distribution did decline, but it's still above the moving average. We're still working off of a negative divergence with the cumulative advanced decline line as well as the regular advanced decline line. But so far, the advanced decline line is holding above this upward sloping trend line. We're also working off of a negative divergence when we look at common stock based on price and volume. Then looking at our broader range, the NYSE is just a little bit below the moving average. The S&P did show some weakness, but is still above the moving average. We dropped below with the mid caps, and the small caps came right back up to their moving average. Looking at our trend, this is the ADX. It's rolling over a bit, but it's still above the moving average. The green line is on top, but it is also declining. Volume is picking up just a little bit because we had an increase in Tuesday's session. Short-term analysis, we came right up to this resistance level, and now we're starting to come back down. Will that continue? On the bottom, you see where we were slightly above average with volume. Looking at our stochastics, and please remember these are further subdivisions of the short-term time frame. Our short term is no longer extreme. The intermediate term is also coming down after being extreme. The long term is still going up overall, even though it ticked down slightly. The Stoch RSI is no longer extreme positive, nor is the Williams percent R. The CCI 14 has dropped and the CCI 20 has dropped. But this is kind of encouraging. Right now, we're still down at this moving average. Now, this is the exponential moving average. We have a little bit further to go to get to the simple moving average, but so far, this support level is holding. Looking at the 20-period double and triple exponential moving averages, these move a lot faster, so we have dropped below that. The force index has dropped just barely below zero, so that's slightly negative. And our CMB index, after giving us an extreme positive reading, is now starting to come back down. Intermediate term charts, the balance of power is still below the dashed line and ticked down slightly. The double and triple 50-period moving averages, we come down and close just below each of those. Go, no go has switched back to more of a neutral. It's a lighter shade of blue. And then we're watching this as well. This is an anchored moving average going back to the all-time high. If we continue to fall, we're looking at the 40.79 level as potential support. The TTM squeeze also showed a little bit of weakness where it turned from a lighter shade of blue to a darker shade of blue. And we've come right back down to the midpoint with our standard deviations chart. The Bollinger Bands were just a little bit above the midpoint. Our Arun has gone sideways, but it's still positive overall. The PPO studies were still positive in the long and intermediate term, and we barely dropped below zero with the short term. McClellan oscillator, we came almost back up to zero, but now we've dropped back down, so that's negative. The NYSE McClellan oscillator has dropped back below zero. The summation index based on price is declining, and we're still advancing based on volume. So we're seeing a little bit of a disconnect here. Is price eventually going to turn volume back down, or is volume going to turn price back up? The Swenlin trading oscillator, this is positive. We advanced on a down day based on price and volume, but we're still working off of this longer term negative divergence. The longer we get away from this, the less relevant that becomes. The PMO is still positive overall. We haven't crossed over positive yet based on price, but we have crossed positive based on volume. The percent of PMOs that are rising did decline. We also have a longer term negative divergence. We turned down slightly with the buy signals, and we're flat to declining with the PMOs that are above zero. The Elder's Impulse system for the S&P has switched to negative. The parabolic SAR system, though, has remained positive. The slope is rolling over a bit, but is still positive overall. Here's all of our different oscillators. With the slope, the TSI and the MACD are positive. The PMO is positive. The PPO. What we're watching are longer-term oscillators. The TSI is starting to cross over positive. The KST is not quite there yet, but is showing some improvement. We're still above all the plotted moving averages. Looking at the BPI, we're coming back down a little bit, but we're still above 50. But longer term, we have this negative divergence. The Sean trend meter, after being extreme positive, has now fallen back down. The NYSE bullish percent index did advance slightly. That's kind of interesting, but we're still below 50 overall. The Chaikin money flow remains positive. The Chaikin oscillator, though, continues to fall, but it's still above zero. The money flow is just a little bit above 50 now, so it actually advanced a little bit. The ultimate oscillator has declined, but is still above 50. The vortex, the green line, has declined, but it's still positive. On balance volume, we've dropped back down below the moving average, and we're still seeing a longer-term negative divergence. When we look at those stocks in the S&P that are above their 200 and 50-period moving averages, they have not been taking part in the rise higher that the S&P has been experiencing. The Copic curve still has a recent buy signal. Looking at our Fibonacci lines, we broke down below this 4170 level, so this may turn back into resistance if prices continue to advance. We've also come close down to this 4123 level. We're about 22 points away right now. That may provide some support. Longer term, we fell back down below the 50% retracement level, and we're about 11 points below this level right now. It did not provide any significant support. If we continue to fall, there's also longer term support at the 4020 level. I've been trying to point this out for a while now. This was inspired by a post by Game of Trades, where we have the two lows that were set back in 2022, and then drawing a parallel line going from the all-time high. We came right up to this level, and now we've been coming down. Is that going to continue to be a problem, or will we be able to break through and go above that trend line? Also, we're now coming into a new cycle. We ended the cycle last Friday. Is that going to signify a change in the trend? And then this blue line is a line of support at the 4080 level. Our different charts, the Heikin Ashi has turned a little bit more negative. The Kegi chart, it's still positive with a black line, but now it's pointing down. The Renko chart, though, still remains positive, and the 3-line break is still positive. Our different indexes, the equal weight, continues to underperform the S&P. The transports continue to underperform the Dow. Looking at our new take on Dow theory, we're still above this support level with the S&P 500, although we are coming down. We did turn down with the NASDAQ, but we're still above this breakout level. The Dow actually broke down below its 50-period moving average. That's negative, but on the positive side, we're still above this S2 level. The diamonds remain negative. The NASDAQ, after coming right up to this level, has now been falling back down. Will this R2 level provide some support? And the NASDAQ, after coming above this 38.2% retracement, we're still above that. If we continue to fall, will this level provide support? On the negative side, when we look at the cumulative new highs minus the new lows, where the S&P has been going up, but we're seeing a real negative divergence. The NASDAQ 100, after coming up, has now been dropping back down. Will this R2 level provide some support? The Qs have switched to neutral after being positive, and we're just barely above this 50% retracement level. That's still below current price, so we'll be watching to see if that provides some support. On a longer term basis, we're still above this anchored moving average, going back to the all-time high with the Qs. The small caps were quite strong earlier in the day, and if you see this bar, we started up and then we closed right down near the bottom. That's not really a good sign, but the mid caps and the small caps did start off the day by being pretty strong. We're still above the 50-period moving average, and we came right down to this pivot level. Will these areas hold as support? Then looking at the Russell 2000, we're still above 50 with the RSI, but we're turning down. The MACD still remains positive. Small caps are showing some improvement compared to the S&P, but they still are underperforming overall. The small caps for the Elders Impulse system still remain positive. And here's what I've been trying to point out. Even though the small cap index has been showing a lot of weakness, lately it's starting to come back to life a little bit. When you look at the growth versus value, it's been actually doing quite well. The mid caps fell down below their 50 and 200-day moving average, but they're still above this support level. The mid caps have also switched to negative for the Elders Impulse system. And we're also seeing the same thing. Now, it did decline in Tuesday's session, but overall, growth has been really outperforming value, even though the index itself has been under a lot of pressure. This is a chart that's a few days old now. I've been showing it for a while. This might suggest that the NASDAQ 100 has become exhausted and is due for some kind of a pullback. Then the NASDAQ 100 BPI, after coming right up to this level, has now turned back down. It was kind of hoping that it might break above this level before it turned, but we'll have to see how that plays out. The micro caps were actually up on the day, and they're still well above 100. And then we're also seeing a real outperformance of the S&P 100 compared to the S&P 500, although it was down in Tuesday's session. The big boys are still outperforming the smaller folks overall when we take a ratio. The home builders, we were down across the board. The S&P was down, the home builders ETF was down, the ratio was down, which is actually improving the relationship a little bit. Looking at the financial sector, we're still in an overall downtrend, and the financials continue to underperform the S&P, and the regional banking ETF is underperforming the financial sector, even though it's bouncing back a little bit. Bonds, we had bond yields were down and bond prices were up on the day. And then we're watching this too, the longer term correlation between stocks and bonds. It's starting to show that they're going in opposite directions. In the shorter term, they're also headed in opposite directions, and the spread is still really wide. This is not necessarily normal and not what we want to see. We just keep an eye on this to see if it tells us anything. Right now, it's just looking kind of weird, meaning that stocks and bonds are having a tendency to go in opposite directions, at least in the longer term. Our long-term analysis, we're still below the special K. We were not able to break through that. Then this is a new chart that I showed yesterday from Zahorchak, which is quite a name to have. This doesn't generate very many signals, and it had been negative for 2022 and into the early part of 2023. Well, now it has registered a buy signal, and this is much longer term. Our long-term analysis, we're still holding up here with the MACD above its moving average, suggesting that this breakout above this trend line is still legitimate. An update of our possible positive scenarios, growth versus value still is really outperforming overall. When we look at the 19-day exponential moving average of the advanced decline ratio, we dropped below zero based on price, and we're just barely below zero based on volume. The Qs to the S&P are still holding up quite well. Discretionary is kind of lagging behind here, and we turned down a little bit with large cap growth versus large cap value. When we look at the large caps, again, it turned down a little bit. The mid caps also turned down. The small caps are lagging behind. But this is also potentially positive. The S&P to utilities ratio. When the S&P is really doing well, this ratio is really going up. It had been chopping more or less sideways, and it could be starting to break out here. But when we look at the broader range of the highs minus the lows, we are still below zero. And then another way to look at the longer term is the 50-period exponential moving average of the new highs minus the new lows. This indicator is ticking back up, and our indicator itself, which is the black line, still is above zero. The 2-year Treasury yield, we were hoping that this spike and then drop was going to give some support to stocks, but now the 2-year yield is starting to go back up. This is encouraging, though. The Staples to S&P 500 ratio. This ratio continues to drop overall. If you look at other times when this happened, that gave some really good support to the market. In 2022, we were faked out a lot. These signals were being generated, and sometimes they worked, and sometimes they fizzled out. The problem that we have when we look at this is we don't really know if a spike is valid or not. Way back in March, we saw a couple of spikes here, thought they might be something, only to have it come out and put in a new spike. So this is where we have to be careful. So what's our outlook for Wednesday? We're still dealing with earnings season. The technicals are positive for right now, but we are pulling back. We're falling back down after hitting resistance. We have the weekly MBA mortgage applications index that'll come out, and we'll also be getting the meeting minutes from the FOMC meeting that took place on May 2nd and 3rd. That will come out at 2 p.m. Eastern. And then the whole list of geopolitical events. The debt ceiling is kind of the issue for right now. Looking at the Stock Traders Almanac statistics, we are still in the middle of the week after options expiration. We tend to be up more than we are down. And then looking at May 23rd, in and of itself, we're neutral to negative with the Dow, but we're more neutral to positive with the S&P as well as the NASDAQ. And then we are also positive overall for the month of May. We're on the 18th trading day of the month. The green dashed line, which is what we follow, does show a decline. We're also coming into that weaker part of the cycle, no matter if we're in a pre-election after a midterm bear, which is the green line, or all pre-election years, which is the black line. We still see some weakness overall. May ends up being weak overall, but we're focusing on this blue part here, which is positive, but it still underperforms the rest of the months. And then this goes back to 2011 and different things that happened when they had the last debt crisis, where the S&P is at, and then what happened after that. And then Chivago Capital also posted a chart pretty similar to that. We did see some weakness after the debt ceiling agreement was reached. We tried to bounce back, and then going into the latter part of summer, there was some pretty significant weakness. So our scenarios. Hard to go with the down one right now because we're not really trending and we haven't really switched over. Can't really go with the up one because we did have a down day, and we're also in a very weak trend. So we still default over to the sideways or neutral trend because the ADX is still above its moving average, but both of them are below 20. The green line is on top, but it is declining. We have one speech coming out on Wednesday that'll be given by Governor Waller. So our warning signs, there are still numerous negative divergences, and these may last a while. These charts that we're looking at cover long ranges of time. The VIX is still showing a lot of complacency. The S&P new highs, they are lagging behind, but they are improving. We're actually in an uptrend overall, but they didn't really participate when the S&P was going up higher. The NASDAQ cumulative new highs, new lows, they are continuing to show weakness. The S&P is underperforming utilities, but this is one thing that we're watching. It does look like that could be improving. The risk-off posture, we may be switching back over to a risk-on posture, but so far that hasn't happened. The small cap index continues to underperform. That's when you take all of the index together, as well as with the mid caps, and we also had a recent death cross with the mid caps. Is the NASDAQ and NASDAQ 100 due for a pullback? It has hit some upper resistance. It's also pulling back based on that 9-13-9 chart. And then we are still dealing with earnings season, which I always say can be either positive or negative. Our positive signs, we still have the Copic curve that generated a recent buy signal. Our longer-term seasonality and setups, those apply to the whole year. Lower price levels may provide some kind of support if we continue to fall. The NASDAQ is still above that resistance. It broke out. Now it's just pulling back a bit. Small and mid-cap growth is continuing to show strength. Will more weakness shift things over to negative? That's the question that I'm trying to answer right now. And then will a resolution of the debt ceiling, will that produce some kind of short-term rally? So our conclusion, the S&P, it's positive, but pulling back, not trending, and showing a lot of negative divergences. The overbought condition that we had after Friday has now been worked off. In the short term, we're positive, but showing some weakness. Intermediate term, also some weakness, but we're still positive. We still remain positive in the long term. Thank you. I hope you enjoy this video. I hope you have a really good day, and I will talk to you in the next video.